It's Friday, January 24th, and we are talking Netflix and Alphabet. I'm your host, Dylan Lewis, and I'm joined by Fool.com's Dan Kline. Dan, what's going on, man?
Our long nightmare in South Florida is over. It's no longer 50 degrees. We're back up to 70. People can put their fur coats and scarves away.
We live different lives during the winter months, Dan. I'm going snowboarding tomorrow, so we're living very different lives.
I went to the hot tub on the 55-degree day. It was a little cold getting out, but people here absolutely don't know how to deal with any sort of weather. And I also can say I did not see any falling iguanas.
Well, Florida, I think, is making you a little bit soft, Dan. I got to be honest. As someone who grew up in the Northeast, I think you got to work on that.
I think there's a reason I'm doing this show from home and not in studio today.
Well, I'm having you on because we're talking about Netflix and Alphabet. We're going to be talking about the streaming space, and you are one of my favorite people to talk to when it comes to streaming. And I think if you look over the last couple of years, there's a lot of debate about when the golden age of television was. I would say right now might be the golden age of television for consumers, in terms of options and great deals for creators, especially people that maybe haven't had voices before. It's a pretty awesome time to be a viewer. There's so much excellent content coming out there because all these companies are hopping into the space. Now, that means that the space is also getting a little bit more competitive if you're a streaming company.
Yeah, and we've also had the end of, maybe not the full end, but the stigma of doing television. When you see major name actresses like Nicole Kidman doing a limited edition series on HBO, that's a big change. And maybe movies have lost a little bit of luster. It's hard to make a mid-price movie now, but that's very much been television and streaming's gain.
Yeah, there's a lot of cachet being thrown around. I mean, you think about like the HBO series True Detective and what that did for Matthew McConaughey. And you look at what he did as a movie actor. We kind of have the McConaissance because of TV. So I think we can all thank streaming television for that one, Dan.
Yeah, and there's just more work. And, if you're an actor and you no longer have to commit to a grueling 22 episode, 8 months of the year shoot, and instead could do, The Mandalorian was 8 episodes. You can put more time and care into a short run show. And sometimes you can tell a show in the amount of time it takes. A certain story maybe doesn't need 22 episodes. I recently finished the 3rd season of Daredevil on Netflix, and it didn't need to be any longer. It was really good, but it got the story out there in a sort of non-traditional time frame.
You mentioned The Mandalorian. Of course, this is a show from Disney Plus, part of that Disney IP library. And the launch of Disney Plus was really one of the biggest stories in streaming for 2019. We are talking about streaming and Netflix today because we have some updated earnings numbers from Netflix and some commentary from management. And what it seems like is, as people might expect, the entrant of a big, deep-pocketed player like Disney is starting to have some effect on Netflix.
It's having a very mild effect. And the reality is Netflix posted 8.76 million new subscribers. It caused an uproar because it missed slightly on its US subscriber prediction. So, of course, people flip out. Are people dropping Netflix? Are they getting Disney Plus? And the reality is, as people cut the cord, there's going to be multiple tiers of streaming. And Netflix and Disney Plus are both, for most people, going to be in the you have to have them tier. If you have a family, you pretty much need Disney Plus. If you want a depth of content, then Netflix is probably going to be what you have. So I don't put a lot of stock in there's more competition. CBS didn't go out of business, and I read this somewhere. I apologize for whoever I'm cribbing this from. CBS didn't go out of business when Fox launched. There's sort of an endless demand, and the universe keeps getting smaller and more niche-y, and that's bad for water cooler discussion, but it's probably good for people who like television that doesn't have to attract 12 million viewers.
It's funny. On the walk to the studio today, Austin said after he goes through the Marvel universe of movies, he is done with Disney Plus, going to be taking a break. I'd be curious to see. I want to check in on that in a couple months because there are a lot of people, I think, who look at all these streaming options and they say, okay, well, there's a lot of stuff in this catalog I want to watch, but then it's not going to come out again. We're not going to get that update for another year or so, so I don't need it. Those are really good intentioned ideas, but the reality is people are lazy and they're not so great at canceling services.
So Austin, if I remember correctly, has a fiance but not a family.
Yes, that's correct.
I have and you have a girlfriend but not kids. I have a 15-year-old and a wife. So I'm mostly done with Netflix. There's really nothing except the occasional comedy special that I'm super eager to watch, and I'm in the midst of catching up on the Arrowverse, which I've been watching on the CW app because I'm ahead of where Netflix has. So I could drop Netflix, but the reality is, one, T-Mobile pays for the vast majority of my Netflix. Two, my wife loves Netflix and watches hours and hours of it when I'm not there. So it's become a bigger decision. And Disney Plus, for an adult, you could argue you could come in and out. Watch the movies you want to watch. When a big series comes out, maybe Austin really wants to watch the Loki series, so maybe wait till all 6 episodes of that are out and sign up for a month and watch them and a couple other things. You can pick and choose, but honestly, for most people, $6.99 a month isn't that much money, especially if you dropped a cable subscription where you were paying $140 or $150. So I don't really think budget is going to be a factor, and the average single person might be able to hop from services. People who are sharing these services with other people in the house, I probably can't get rid of Disney Plus because my son's watching Clone Wars and maybe he wants to catch up on that, and then something will come up that I like. So I think the lesser services are going to suffer, but the biggest services will probably just become perennials for most people.
Dan, you're not in the studio, so you couldn't see Austin's reaction to you saying that Netflix is something that you don't love, you don't need in the same way. He was visibly disgusted. I am a Netflix subscriber, as is Austin. I think to your point, we don't have families, so we don't see the same value in Disney Plus. And I agree with you. I think some of the blowback with Netflix's earnings and these numbers are it's a little overblown. The fact that they added over 8 million new streaming subscribers and they crushed expectations. It was 7.8 million for expectations, 8.7 in actual additions. It shows that there's still a lot of runway and a lot of resonance with what Netflix is offering people.
Yeah, and average revenue per user is up 9%, which is basically due to the price increase. So they raised prices, which is not a well they're going to be able to go to all that often because they're already high in the space they're in. But if they're on sort of like a Costco like every few years schedule, they've shown they could do that. And to give people perspective, there are 84 million cable customers, cable and satellite, that includes streaming in the US. And Netflix has 61 million subscribers just in the United States. So 75% of the audience of every cable channel Netflix has already reached. So it makes sense that their US growth is going to slow down. And I think they have been hurt. It's not Disney Plus specifically that hurt them with new subscribers. It's The Mandalorian. It's Netflix has not had a buzzy show that everyone was talking about. And you and I have talked about this personally. I think Netflix hurts itself by releasing every episode at once because The Mandalorian was an 8-week story. It was part of the zeitgeist. People talked about it. And Stranger Things is like a 72-hour story.
Yeah, I think that's 100% right, Dan. One thing that I am noting a little bit with this quarter and want to continue to watch with Netflix going forward is what churn looks like. We've kind of taken for granted that there's a certain stickiness to Netflix and that people are generally super satisfied with the platform. Netflix is kind of one of those companies like Apple where the people who have it seem to absolutely love it and it's part of their routine. But as more people come into the space, you need to be aware of the people that are leaving, particularly because if they are making that decision between paying, $12 for Netflix and $7 for Disney Plus, and they only want one, they might go cheaper, or if they're a family, they might go with the Disney Plus option instead.
So Netflix has sort of a predictable churn pattern, and they address this in the earnings call. Basically, in the second quarter, they released a whole bunch of highly anticipated shows, sequels to things that had done well, a couple of big name Hollywood movies starring one with Ryan Reynolds, I think one with Will Smith. I might be getting the timing wrong on that. And sometimes people will join for a quarter, watch a bunch of stuff, and leave and wait until a new show is released that they want. So there's always going to be some churn, but we have not seen any significant amount of pattern of like, I'm only getting Netflix 1 month a year, or I'm going to be on for 6 months, off for 6 months. Their numbers have steadily moved up, and the churn number, it inched up a tiny bit in the quarter. And it's something we should keep an eye on. But I think as long as Netflix can put out content people want, people will keep it. Now, the problem is they released a stunning 802 hours of content in the fourth quarter, which is a record and 38% higher than the same period last year. And Dylan, let me ask you, can you name 3 Netflix shows that were released in the last quarter?
I don't think I can. Not as
I
a
can.
consumer. I realize as you asked me that, like a lot of the stuff that I've been streaming recently is old stuff on Hulu. I haven't really been watching Netflix all that much, and that's because I think you get really into a series, and that's what you start watching for a while. But to your point, Dan, no, I can't.
Yeah, I mean, I could name three comedy specials because those seem to feature prominently in my feed. Comedy specials are also generally downloadable, whereas some of the series are not. And I'm on a plane a fair amount, so to watch, some mindless comedy special is easier than to decide I'm going to take on The Witcher or, or a very serious, heavy show. So I do think Netflix has to focus a little better. And they also had, there was a long time where if Netflix produced a show, you could be pretty confident you were going to get a few seasons and a logical conclusion. They've been much more willing to cancel a series, which has been made me much less likely to watch a show. I generally have a rule that I don't watch season one until I know there's going to be a season two. In some series, they've eliminated that by telling you there's going to be a season two before season one airs. But in a lot of cases, something might look promising, and I'm not going to invest that time if it's not going to be a satisfying experience because it ends abruptly.
There's an emotional investment that comes with watching TV, Dan. I 100% hear you on that one. You don't want to get invested in these characters, invest in these plot lines, and then just have the rug pulled out from underneath you.
Yeah, and I think it's okay if something airs for one series, towards the end of it, they realize it's not going to make it, and they just conclude it, and it just becomes a one-season show. I think that's fine. But if you start watching something from the beginning, and then like 8 months later, you can't wait to find out what happens, and they don't even put out a press release telling you like, hey, this is what would have happened if the show went on. It's very upsetting, and frankly, it's a waste of my time, and time is valuable.
So you're not enjoying the journey. You want to know the full arc, Dan.
I've always been a person who reads the last page of the book first. like I want to know how it unfolds, but like the example I'll give is I've seen the latest Star Wars movie, and for like the two people who haven't seen it, I won't give any spoilers, but I can't wait till the book comes out because now I know what happens, but I want all the details filled in. That's always more
Ah.
interesting to me than necessarily the exactly what happens.
Well, I'm one of the two people that haven't seen it yet, so please don't spoil it for me.
I'm the other one.
It's all about Baby Yoda.
Who would have thought we're all aggregated in one studio, the two people that haven't seen the new Star Wars movie? Dan, while we have been dogging some of the content releases from Netflix, I think it's worth underscoring they have been wildly successful with most of the stuff that they've released, at least in terms of the like tentpole franchises that they're trying to get out there, and they've been very successful when it comes to the award show circuit.
Yeah, I mean look, they led all studios with 24 Academy Award nominations. They put out a huge, Michael Bay film, Six Underground, starring Ryan Reynolds, that was watched by 83 million households. Now, when we say watch, let's remember that the Netflix metrics for watch is now 2 minutes of a show. So, in theory, you don't have to get very far into a movie and turn it off for them to still consider that you watched it. But obviously, they've figured out a way to be both prestigious and to have sort of lowbrow stuff like Adam Sandler movies that people are just going to watch reflexively. I'm actually talking more with the content about the other 760 hours where you log into Netflix and you'll see like 8 new series and you won't know what any of them are about. You didn't see any media coverage, and I'm sure some of those are designed to keep 400 or 500,000 Netflix subscribers very happy, and it's very specific programming. But I do think they probably need to get their batting average a little bit higher to control their costs more.
So, for folks that may be a little concerned about some of this competitive stuff that we're talking about, especially if you're a Netflix shareholder, it's important to realize stock took a little bit of a hit. It is right back up to where it was. So, this is not a long term ongoing thing. This is just kind of some short term reaction from the market. And the key quote in looking at the letter from shareholders came from executives and said, our low membership growth in the US and Canada is probably due to our recent price changes and to US competitive launches. I think going forward, anytime you see management talking about the competitive landscape in streaming, there is going to be some concern just because this is a pure play company. They don't have some of the benefits that a Disney does with a massive IP library and all of these other ancillary businesses. They are going it alone, and it's going to be a little harder for them.
It is, and I think it's very important. So just like I don't think you should look at any retail store 1/4 of same store sales to make a decision, Most of the time, historically, when Netflix has missed on a subscriber count number, their timing's just a little off. So a couple of quarters ago, they were, I think, almost 2 million off on the total number. And then the next quarter made that up and then some. So Netflix is not magic. They can't exactly predict just because they're releasing a new movie or show that people want to watch if they're going to sign up on November 1st or December 15th. So I think you do want to look at the long-term trends and make sure that they're hitting roughly what they say they're going to hit on an annual basis. But I don't think you should put a lot of stock in they're 200,000 down here, they're a million five up there. That's just not the most important metrics. It's, are they engaging people? Are they continue to drive forward? And are they growing in countries where they don't have the same programming base, at least in the native language, that they do in the US? And they're checking off all of those boxes.
Yeah, I would add to that too. If they're able to continue to raise prices without creating huge hikes in churn, that shows that they have pricing power. It shows that they have the ability to put out great content that people feel is worth paying for. And that's another sign that they have a resilient business.
Yeah, I question whether they'll hit a pricing wall. 1999 is a commonly used price for a reason. Once you go over that, it's people start to think about the cost of things. But it would not be crazy to think that the Netflix of the future, and I'm talking 7, 8 years from now, might have a sports tier. It might have a pay $1.99 extra and you get all sorts of Japanese anime or who knows what it is. It doesn't have to look exactly like it looks now, and you're seeing that with the Comcast Peacock launch, that they have multiple tiers and multiple offers and different deals if you're a Comcast customer. So Netflix could do that. They also could continue to do things like their T-Mobile partnership that defray the cost. So maybe 5 years from now, Netflix costs $24.99, but every ISP in the country is paying for half of that for you because you're using, your internet to watch Netflix primarily.
It's not just the golden age as a viewer. It might also be the golden age as a bundler, Dan. There are a lot of really good deals out there, and that's a great point.
It's very tricky. I mean, because we the next one we're going to be talking about in the is NBC's Peacock, and I don't mean on this show. I mean in the next time we talk about these things. And they're basically giving it away. There's an ad-supported tier. There's free offers for their customers. So is their product inferior to Netflix and Disney Plus? I would argue that for most people, yes, it is. It doesn't have the content. But if it's free, it becomes like Amazon Prime. Maybe when you're bored, you decide to watch The Tick and see if it's good, or Man in the High Castle, or whatever it is. And it doesn't have to be the driver. And then all of a sudden you have it. And Comcast has the ability to sort of, and so does Apple, to sort of disguise how you pay for it. If you're getting Apple Plus for free and they raise the price of the iPhone by $30 accordingly, or a Mac, you don't really know that they've done that. And Comcast can kind of do the same thing with internet pricing or cable pricing. So it's not going to be a straightforward market, and there's going to be an awful lot of winners. And the only real losers are going to be the very small players.
All right, Dan, so we have our newest entrant to the $1 trillion club, Alphabet, and this is the parent company of Google. They finally hopped into the 4 comma club, as Russ Hanneman from Silicon Valley might put it. And I think that this company has kind of flown under the radar for a little while. There's been so much going on in the world of big tech, and they've just kind of been chugging along. But thanks to this $1 trillion valuation, them peaking past that number, and some shakeups in management, I think it's worth checking in on them because there's a lot going on.
First of all, do you think they get like a plaque or a jacket or like some sort of $1 trillion club notification?
I think it's probably like when we passed 100,000 subscribers on our YouTube channel. YouTube sends you a little plaque when you pass 100,000 and a million. We have to work a little bit more to get to the million, but I'd like to think that like the New York Stock Exchange or the NASDAQ reaches out.
So sending my son a picture of myself with that plaque might be the only thing that ever impressed him. And I'll point out that plaque is just sitting sort of haphazardly on a table in the office. It's not displayed anywhere. It's not. But to a 15-year-old, that kind of meant Dad was famous in an indirect way.
I'm happy to help you with your kids, Dan. And I'm happy to help folks on YouTube, too. I love working on that side of our business. YouTube, of course, a Google property. So to get people up to speed quickly on what is going on with this company, we have some major news items. We have founder Larry Page stepping down as CEO of Alphabet, the parent company of Google, and the former Google CEO, Sundar Pichai, is now running both Google and Alphabet. And I think we need to have a brief history lesson on the movement from Google being the name of the company to now Alphabet being the name of the company. This happened back in 2015, and they moved to this holding company structure because they felt like it would allow them to better break out their financials in a way that represented the business, but it also put them in a position where they would have all of these discrete business segments that would allow for individual executive teams. Sundar Pichai was the person who ran Google as it was kind of shelved off and identified as its own internet property unit. And it seems to me like with this move, it was probably done with the intent to eventually groom him to become CEO.
Yeah, I think that's fully accurate. And it was done for shareholder transparency. And this is actually somewhat rare in the technology world. They didn't want the success of Google and YouTube and search and paid ads and all the company's successes to disguise how much they were investing in, it's big bets, it's moonshots business. They wanted you to be able to look at something like Waymo, it's a driverless car company, and say, okay, this is what we're putting in, and this is what we're getting out of it. This structure also allows for some of those businesses that are heavy investment and could pay off well to take on outside investment or have different boards of directors and different structures. And that's happened in one or two cases. But basically, this is all about sort of showing people what they're doing with their money in a way that's, I think, very refreshing.
I was a huge fan of it when they decided to do it. I knew that we were going to be kind of getting some more details down the line. We have them now. But if you want a quick, like, 10,000-foot view of what goes on with their financials, the internet property business, like you mentioned before, Google, YouTube, all the things that you think of when you think Google, for the most part as a consumer, that's like 99.5% of how they make their money. They have their other bets segment where they have all of these moonshot projects, like you mentioned before, about 0.5% of their revenue coming from there. So this was really a move towards more financial transparency, gave us a much better lens into the core business, and then also how much they were investing in this other stuff. Now, what we're seeing is over the last couple of years, there's been a lot of management at Alphabet deciding, we need to be thinking a little bit more critically about some of these projects.
Yeah, it's sort of all fun and games to say we're gonna change the world, we're gonna do all these things, but when you realize you've spent $8 billion on what they call other bets, and you've only brought a 1.5 billion back, maybe there is a need to be more responsible. And the reality is, Google doesn't have to change the world itself. It can take a project to a certain point and then it's investable and you can bring other people in. And there's obviously a lot of money out there that wants to work with Google that can partner and take risk away from shareholders. As a business, Google has been a growth story all year, up 17% in the first quarter, 19 in the second, I think it was 20 in the third, 40.5 billion in the third quarter. So the numbers are great, but you haven't seen those new hits. None of those projects have moved beyond, into the real world, and we've seen some failures. Google Glasses was largely a failure. So again, this is about accountability and setting up structures for these businesses where they might have a chance to win and become successful companies in their own right.
Yeah, absolutely. And I think they are in a pretty privileged position as a company because they have this legacy. It's crazy to call Google search legacy, but it is legacy in the eyes of kind of the Alphabet holding company. They have this business that creates a ton of money. It's very high margin, and it's still growing at, like you said, high teens, 20%. That gives them so much cash to do stuff with. And Sergey Brin and Larry Page have really wanted people to think outside the box and have these really innovative ideas. To give you a sense of what some of these other bets look like, there's Waymo, which was kind of formerly known as the self-driving car project. There's Sidewalk Labs, which is a smart city technology startup. There's Verily, which is in life sciences. Calico, Project X, Capital G. There are a ton of these. You can only get to the position where you're funding all of these little bets because you have so much money on hand.
Yeah, and what they also don't talk a lot about is there's a tremendous amount of money invested in evolving search and YouTube and the other successful Google products. That's a very competitive landscape. But these are all theoretically huge ideas. I mean, if you could become the lead company in self-driving cars, that's obviously something that's going to be, at least in certain markets, a very big area. And this is giving accountability to that and making it so, maybe some of these companies will be shut down. Maybe some of them will be acquired. Maybe they'll partner. There's all different ways to do it. And by putting it all in this one system and sort of taking the emotion of the founders out of it, it gives Google a better position. It's better for shareholders. I mean, if I was an investor, I'm not sure how much of my money I want put into 10 projects that are all very risky. This isn't YouTube launching a new show. This is, billions of dollars of investment for things that may not pan out that others are also trying to do. So there's no guarantee you win.
I am an Alphabet shareholder, Dan, and I would say I will kind of look at this business as something where they have a monopoly in one of the greatest pieces of real estate you can possibly have. Their webpage is the homepage for a lot of people who have Google Chrome, and it is the default search engine if you're in the United States for sure. So they have a business that's not going anywhere, and it's pretty much a monopoly. And all of these other bets are basically lottery ticket type investments where they're putting money in and it feels like a lot because, yeah, it starts with a B, it's billions. But these are businesses that could wind up being really, really big down the road. And maybe they start to lessen their exposure to them. Sundar Pichai has talked about how they may follow a model very similar to what they've done with Verily, where they've gotten some outside investors, they've created an independent board. But I look at those and I say, even if they wind up getting some other folks to help fund some of this stuff, they're still going to have pretty big exposure. And if any of these ideas take off, then boom, that's another great business for this company.
Yeah, and this becomes what I think of as the Apple problem. So if you look at Apple revenue and you look at, say, the watch, it doesn't really feel that successful. But when you look at the overall wearables market and the percentage of it Apple has and the growth numbers it's putting up, if that was a standalone company, we'd all be fighting to buy it. And to a lesser extent, you could say that with a lot of other things they've done. They're so big that having a hit that moves the needle just isn't that hard. It's very, very hard. So in this case for Google, they spent roughly 2.7 billion in the first three quarters of the year, and they only brought in about 500 million on that. So they're losing a lot of money on these. But in the bigger picture of Google, what's a $3 billion a year investment? It's not that much. And if one of these ideas pays off, even in kind of a mild way, they're playing in such a big space that it will probably work. But for something to be considered successful for Google, it has to be absolutely gigantic.
And the reason we're talking about the other bets is Sundar Pichai gave an interview recently where he indicated that kind of following in the footsteps of Ruth Porat, the CFO that they brought in who had more of a Wall Street background, he is going to be looking at a lot of these operations with some more discipline. And so you could expect some outside investors to be coming in. And I think you might start to see Alphabet look a little bit more critically at some of these operations. They obviously want to find that next massive growth lever for them, but I think they also want to be wary of spending too much money on those things.
Yeah, and look, you need to be aware of where your investment is going. And when anybody starts a business like this, they do a business plan, just like if you and I were starting a coffee shop. And there are milestones, and you want dreamers, but you also want numbers people to say, hey, you said you'd be here at this point, and you're not. And to make a decision, can you get back to that? Or have you proven out that there isn't a market for this? Or in the case of something like Waymo, did so many people enter this space that maybe you should buy something, maybe you should partner with somebody else huge? There's a lot of decisions to be made, and they shouldn't necessarily be made by the idea guy. They should be made by the idea guy holding hands with a very responsible CFO type. And Sundar Pichai seems to be putting in some of that discipline.
All right, we are going to wrap the Netflix and Alphabet discussion there. Before we wrap up today's show, though, I want to kick it over to our iTunes reviews. As I've mentioned on the past couple Friday episodes, if folks give us a 5-star review in iTunes, I'll go on and read that review and answer any questions they might have in the review on the air. Give them a little love. We always appreciate getting some love from our listeners. And if you want something discussed on the show, just write in industryfocus@fool.com, or you can get us at MF Industry Focus on Twitter as well. So Knightsbud writes in, very good podcast, has helped me understand markets, things to look at, look into, be aware of, and best of all, helps me get my retirement portfolio in order. They do a great job with keeping things interesting, on topic, yet are still able to mix in humor, real life, and break away from the topic to keep the show fun. Dan, I think you're particularly good at that. That's one of the reasons I love having you on the show, is you always bring the humor into it.
I appreciate that. It's we are called the Motley Fool, so I try to bring a little of that to every interview.
100%. We got to have some good fun with this. MJW writes in, I listen daily and love it. I'm also digging the new intro and the checks and balances track. Austin Morgan just threw his hands up in the air. And don't worry, MJW, we're going to be playing today's episode out with that checks and balances track as well. MJW goes on, I'm more excited for the new Wednesday show because I typically would skip the Wednesday healthcare episode. Keep it up, guys. And I know that we've had some listeners that have written into the show and said, healthcare was my absolute favorite. I'm bummed that you guys are getting rid of it. The plan for us is to regularly have folks like Todd Campbell on that Wildcard Wednesday episode, and also bring Shannon Jones back for some episodes on healthcare. So if you have a specific healthcare topic you want to hear us talk about, please write in, because we're looking for ideas. We want to make sure that we're still scratching that itch for our listeners. But we had to make some programming decisions based on the expertise that we had with the hosts. And so that's kind of how we wound up where we wound up. Dan, I don't think anybody wants you and me alone doing a healthcare episode.
No, I mean, we could do an episode on CVS or some of the consumer related stuff, but I don't think they want us breaking down biopharma stocks.
I think that's right. I could do that with Todd Campbell.
Word.
It sounds right. I could do a show like that with Todd Campbell, but I certainly couldn't do it on my own. And so we're just trying to marry people's expertise with the content that we're going to be covering to make sure we're doing a good job doing that. And we've got one more here, and this is actually going to tee up something that'll be coming at you guys in a couple weeks or so. What's What writes in, love the content, love the hosts, getting used to the new intro. Not quite as ringing an endorsement, Austin, but still pretty good. Getting used to it. I'm 23 years old, and the whole family of Motley Fool podcasts has made me more excited and informed about investing. Looking forward to 2020, and a special shout out to Emily Flippin as she hosts the CGIF show. She's awesome to listen to. One of my favorite episodes to date was Dan Kline and Maury Backman talking about 5 tips for buying a new home. I'm nowhere near ready to purchase a home, but some great insights to think over the next couple of years. I would love to see an episode about tips for buying a car, because that is something that I had to do recently and couldn't find a ton of content out about it. Fool on, Dylan from Boston. Dylan from Boston, thank you for writing it. And I appreciate that. Dylan from DC, reading it here, loves to see another Dylan out there, and he spells it the right way, Dylan. You gotta love that. And Dan, you are going to be doing this show with Emily. This is like the perfect review to cue us up for an episode. You are going to be talking with Emily about the car buying process. I think an episode for that is going to be going out in March.
Yeah, I think this is a perfect example of how we listen to our feedback. So Emily sent me that comment and said, hey, you did this show. Do you want to do a car buying show? So she's got a couple of weeks of vacation. So we're taping it next week, but it's actually going to air in March. And if listeners send us good ideas, that's 1,000 times easier for us because we don't have to think of ideas. We can just do the things you've asked us to do. So please tell us what you like. If you tag me at Worst Ideas on Twitter, there's a decent chance I'm going to answer you, even if you say I'm not very good. So we really want to interact. We want this to be your show. Really excited to tape that show, and also should shout out Nick Seipel, who I think was the host of the show on house buying.
I think you're right. Yeah. So listeners, put another way, let us be lazy. Come up with ideas for us, and then we'll be happily talk about them. Dan, thank you so much for hopping on today's show. I'm looking forward to that car buying episode down the road.
Thanks for having me. And people should also remember, check out our YouTube channel. Dylan will not promote his own work, but he runs that stuff, and there's really a lot of great videos there.
Oh, thank you, Dan. That's too kind. Listeners, as Dan mentioned, there's some great stuff on YouTube. Not so many of the podcast episodes there anymore, but some really good investing content for beginners. You can catch it over there. Like we said before, if you're reaching out to the show, industryfocus@fool.com is where you can send those emails, or you can tweet us at MFIndustryFocus. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against stocks mentioned, so don't buy or sell anything based solely on what you hear. Thanks to Austin Morgan for all his work behind the glass today. For Dan Kline, I'm Dylan Lewis. Thanks for listening, and Fool on.